Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Understanding Credit Risk, a comprehensive guide for businesses. Credit risk is a key part of finance that every business needs to understand. It's about the chance that a borrower won't repay a loan. This risk can impact your company's financial health and decision-making. Do you know how to assess and manage it effectively? In this guide, you'll learn what credit risk is, why it matters, and how it affects your business operations. We'll tackle the signs of potential risk and share strategies to mitigate it. By the end, you'll be equipped with the knowledge to make better financial choices and protect your assets. Whether you're a small business owner or a finance professional, mastering credit risk can give you the confidence to navigate the world of lending and borrowing. Let's get started. What is credit risk? Credit risk refers to the possibility that a borrower will fail to meet their debt obligations. This risk is crucial for lenders and investors, as it can lead to financial losses. Understanding credit risk helps businesses assess the potential for default and make informed decisions regarding lending and investment. So, why does credit risk matter? It not only affects individual loans but also has broader implications for the financial system. When lenders incur losses due to defaults, it can lead to tighter credit conditions, reduced lending activity, and even economic downturns. Types of credit risk. When it comes to credit risk, multiple dimensions come into play. Here are some key types that every business should be aware of. Default risk. This is the most direct form of credit risk. It occurs when a borrower fails to make required payments on their debt. Understanding a borrower's financial health, credit history, and repayment capacity can help in assessing this risk. Concentration risk. This type arises when a lender has a significant portion of its loans concentrated in a single borrower or industry. If that specific borrower or sector struggles, the lender faces heightened risk. Diversifying the loan portfolio can mitigate concentration risk. Counterparty risk. This is relevant in trading and financial transactions. It involves the possibility that the other party in a deal may default on their obligations. This risk is particularly important in derivative transactions and can significantly impact market stability. By grasping these various types of credit risk, businesses can better prepare themselves for potential pitfalls. Awareness leads to stronger risk management practices, helping companies safeguard their interests and maintain a healthy financial position. Have you assessed the credit risks in your own business? Understanding these concepts can promote smarter financial practices. Factors influencing credit risk. Several factors can influence credit risk, shaping how lenders evaluate borrowers and their likelihood of repayment. Understanding these factors is crucial for making informed lending decisions and protecting your financial interests. Let's break down the key elements that drive credit risk assessments. Borrower-specific factors. Individual borrower characteristics play a significant role in determining credit risk. Here are a few critical aspects to consider. Credit history. A borrower's past borrowing behavior is one of the strongest indicators of future repayment ability. Lenders look for a history of timely payments, existing debts, and any defaults. A clean record suggests reliability, while delinquencies signal potential trouble. Income stability. Consistent income is vital for a borrower's ability to repay loans. Lenders assess employment history, salary levels, and job stability. A borrower with a fluctuating income may pose higher risk. Debt-to-income ratio, DTI. This ratio compares a borrower's monthly debt payments to their gross monthly income. A lower DTI indicates better financial health and the capacity to take on additional debt. Collateral. Secured loans require collateral, such as property or assets. This reduces the lender's risk, as they can recoup losses in case of default. The value and type of collateral can impact the credit risk profile. Recognizing these borrower-specific factors allows lenders to make more informed decisions about extending credit, tailoring their approach to individual circumstances. Economic factors. Macro-level economic conditions also significantly impact credit risk. Here are some key economic indicators to consider. Unemployment rates. High unemployment often leads to increased defaults. When people lose jobs, their ability to repay loans declines. Lenders closely monitor the job market to assess repayment risk. Inflation. Rising prices can squeeze disposable income, making it harder for borrowers to manage their debt. Lenders need to consider how inflation affects purchasing power and repayment capabilities. Interest rates. Changes in interest rates can influence borrowers' payments. When rates rise, monthly payments increase, which may lead to higher default rates among those already stretched thin financially. Economic growth. Strong economic growth typically boosts borrowers' confidence and repayment capacity. However, during economic downturns, risks increase as businesses and individuals face financial challenges. Staying attentive to these economic factors helps lenders gauge the broader environment in which borrowers operate, facilitating better risk management. Industry risk. The specific industry in which a borrower operates can dramatically influence credit risk. It's essential to evaluate industry conditions when assessing potential borrowers. Market volatility. Industries that experience frequent shifts, such as technology or commodities, may face sudden declines that affect borrower stability. A volatile market can raise credit risk due to unpredictable earnings. Regulatory environment. Certain industries are more prone to regulatory changes. New legislation can impact profitability, thus affecting a borrower's ability to repay loans. Competition. The level of competition within an industry can influence borrower performance. Highly competitive markets may erode profit margins, posing risk to loans associated with those businesses. Seasonality. Some industries, like retail or agriculture, experience seasonal fluctuations. Lenders need to consider whether borrowers can manage cash flow during slow periods or if they rely heavily on peak seasons for revenue. By exploring industry-specific conditions, lenders can identify risks unique to borrowers based on their operational landscape, leading to more accurate credit risk assessments. Methods of assessing credit risk. Assessing credit risk is essential for making informed lending decisions. Various methods exist to evaluate the likelihood of borrowers defaulting on their debt obligations. Understanding these methods can empower lenders to mitigate risk effectively. Let's explore some key approaches to credit risk assessment. Credit scoring models. Credit scores serve as a fundamental tool in assessing credit risk. These scores are numerical representations of a borrower's creditworthiness, typically ranging from 300 to 850. But how are these scores calculated? The primary factors influencing credit scores include payment history, 35%. This factor examines whether borrowers make payments on time, which significantly impacts scores. Credit utilization, 30%. This ratio reflects how much of their available credit borrowers are using. Lower utilization indicates better credit management. Length of credit history, 15%. Longer credit histories can positively influence scores, as they provide a more extended view of a borrower's behavior. Types of credit in use, 10%. A diverse mix of credit accounts, like credit cards, mortgages, and installment loans, can enhance scores. Recent credit inquiries, 10%. When borrowers apply for new credit, it results in inquiries. Too many inquiries within a short time can lower scores. These scores play a critical role in credit risk assessment, allowing lenders to make quick evaluations and decisions based on quantifiable data. While a higher score typically signifies lower risk, it's important to consider other factors in conjunction with credit scores. Statistical risk models. Statistical methods are increasingly utilized to predict credit risk. These models analyze historical data to identify patterns that could indicate potential defaults. Some common statistical techniques include logistic regression. This method helps estimate the probability of a borrower defaulting based on independent variables, such as income and credit history. Decision trees. These provide a visual representation of decision-making processes. They help predict outcomes based on various borrower characteristics. Survival analysis. This technique assesses the timing of defaults rather than merely predicting them. It helps lenders understand when a borrower is likely to default. Machine learning algorithms. Advanced algorithms can process vast amounts of data. They identify complex patterns that traditional methods might miss. Employing these statistical methods allows lenders to enhance their predictive accuracy and make more informed decisions regarding credit risk. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.